strategy was around MACD, right? If the green. Hi, my name is Jay Avdani and welcome to the masterclass. And in this class, we will talk about my strategy. And before we do that, I want to answer the question why. And the answer is because I lost money for the first 11 months of my trading journey and I was focusing on the wrong things. And then once I started focusing on the right things, it actually took me a month or 2 months to find consistency. And that is the question, that is the answer to the question why. Why should you give me the next few hours of your time and listen to this podcast, watch this podcast, and get as much as you can from this masterclass? So in this masterclass, we're going to talk about my journey first, where we started, so that why should you actually watch it. I started in 2019. In February 2019, I lost money for the first 11 months until January 2020. And then I started focusing on the right things starting January 2020. And from February, I started making money. February 2020 was my first green month. And since then, I have been green every year. From February to September, I grew my $3,000 account to $100,000 plus. So if you guys don't know me, my name is Jay Avdani. You guys can follow my channels on YouTube as well. And if you don't know me from the socials, this was just a brief overview of my trading journey. So now we're going to start this masterclass by explaining by answering the question why. Why does the market actually move? And when you search online, because as a new trader, you're going to go on YouTube and search how to day trade for a living, how to trade. That's what I did back in 2019. So you will get the answer that I remember one YouTuber, and the main strategy was that, let's say this was me in 2019. And I was focusing on all the wrong things. And this is a chapter 1 of the masterclass, that the stock market fundamentals, what actually makes up the stock market, the futures market, forex market, whatever you trade, what actually makes the market. In 2019, I was focusing on, say, this is the wrong way to go about it and this will be the right way to go about it. So I'm going to put the right way as green and the wrong way as red. So the wrong way to go about it, this is what I did back in 2019. It's going to be to focus on indicators like MACD. I remember this one YouTuber, his strategy was around MACD, right? If the green or the red MACD lines are crossing each other, that is a reason to buy. And if the red or green, whatever, the lines are crossing each other, that is a reason to sell. And then there are like a few other indicators like Fibonacci level. I'm just going to write down Fibs. And a few other indicators, like there will be like candlestick patterns, purely candlestick patterns. Candlestick patterns actually work, but I would say 50% of the candlestick patterns work. If you're looking at a break and retest, a normal bull flag, bear flag, we are going to talk about bull flags, bear flags, ABCD patterns, the names of the patterns. And at the end of the day, we should not care about the names of the patterns. We should care about why the pattern actually forms. So I can mark it down as patterns, but there's a right way to look at patterns and there is a wrong way to look at patterns. So this is going to be the wrong way to look at patterns, just like a bull flag, a chart pattern. A bull flag is forming. Why is it forming? What's the thesis behind it? What is the market context? If you focus on patterns without market context, you won't make money from the market. You will make money maybe 20-30% of the times and you will lose money the other 50-70% of the times. Because if you look at a dead chart after the fact and you look at a break and retest strategy, yes, you're going to look at this strategy worked out. You're going to be looking at like a dead chart. You'll be like, okay, break and retest works out. I'm going to enter here, make money here. But your eyes won't focus on the other 5 times. Like these are the 5 times it actually worked out. The other 5 times it did not work out. Your brain won't focus on the fact because the break and retest actually failed. So when you're looking at a dead chart, you're looking it from a biased point of view. You're looking it with a subjective mind of view, that you're looking for break and retest that actually worked out. A lot of break and retest, they fail. And your brain, your eyes won't focus on the fails because you are going in with the mindset to look for the strategy, break and retest that actually worked out when you're looking at a dead chart. That is the important fact you need to understand, that yes, you can backtest the strategy, go back, look at the technical charts and backtest your strategy. But at the end of the day, your eyes are looking for that strategy when it actually worked out. And you'll be like, okay, this strategy has a 90% win rate, but at the end of the day, it might even have like 50% win rate or 40% win rate. So you're focusing on indicators at first. And when I started, I was not focusing on what actually makes up the market and the right way to go about it, like change it to green, because red, I was losing money and then I started making money. So this was 2020. The correct way to look at the market fundamentals. It's mainly bulls and bears, right? Bulls and bears. So that means that the bulls want the price to go towards the upside. They are bullish about the price, and the bears are negative about the price. The bears want the price to go down. So it's basically buyers and sellers. Buyers are the bulls, sellers are going to be the bears. So it's basically focusing on Buyers and sellers, you're focusing on that. Now you're focusing on volume. What is volume? Volume is the actual transaction taking place between a buyer and seller. High volume is good for the market. Low volume is bad for the market. You're looking for momentum, what the market momentum is at that moment of time. Momentum, and the thing is that if you focus on momentum, it's going to be like the best strategy, the best chart patterns won't work out if market is waiting for something. We have like FOMC during the holiday season, last 2 weeks of December. If you're just focusing on a bull flag or a daily range breakout or a trend line break or MACD crossing each other or Fibonacci, none of these things are going to work out if the volume is not there, if the momentum is not there behind the move you are watching. If you are the only trader focusing on a chart pattern and it's not followed by momentum, that means a lot of traders like you, they are not focusing on the same name that you are trading. And based on that, there's another thing that you need to focus on, which is going to be that the volume should actually increase. And we will focus on a few indicators that are going to help you gauge if the volume is increasing or not, if the momentum is increasing or not. And the father of all of this is the market sentiment. You need to see what the buyers and sellers are doing. As a rule of fact, and this is going to be discussed during this whole masterclass, when the stock price or index, whatever, something, asset class is going towards the upside, that is confidence for the market. That means the market is pushing towards the upside, the confidence is high. Any downside move creates panic in the market. So remember this. This is the market sentiments. That is the godfather. This is something you need to focus on. You can focus on the market sentiment and you can read the market sentiment with the help of technicals, using technicals along with order flow, and that is what I call the market DNA strategy. Any upside move in any asset class you trade creates confidence in the market. Any downside move creates panic in the market. That's why there's a common saying that the market takes the stairs up. Whenever the market is going towards the upside, market takes the stairs up and it takes the elevator down. That's what everyone talks about, that whenever we move towards the downside, we can wipe out the gains for the past few days within a matter of 1 day or 2 days. It might take market 2 or 3 weeks to go from point A to point B. It can give back most of it within like 2 or 3 days. That's why market takes the stairs up and elevator down. But have you answered the question why? Why does it actually happen? Why does market take the stair up and it takes the elevator down? And the answer is why? Panic is a stronger emotion than confidence. So when you are in a panic mode, the market sells off. That means you see all over the headlines when the market is constantly, constantly pushing towards the upside. You don't see a lot of headlines because eventually all the mindset is that the mindset surrounding any market is like at the end of the day, the market pushes towards the upside. So when the market is doing what it should do, there's confidence in the market. But then whenever the panic kicks in, even when the market drops like 2-3%, for example, so when we talk about CNBC and when we are talking about the sentiment of the market, you will see that when the market is pushing towards the upside, we have seen like maybe during tariff or COVID news, whenever what that happened, the market moved like 50% towards the upside. The journaling, all these news channels are going to be pretty much dead. They won't be talking about a lot because confidence is not as strong as panic. Now, whenever the market drops, like the market pushes towards the upside 20%, say it took like 6 months, 7 months, a year, 2 years, whatever, then it drops 3% in a few days. That creates panic, and that's why you see the headlines. Market dropped 3% from all-time highs. Market dropped. But no one is going to talk about that market is still up 17% from the bottom or 15% from the bottom. You won't see that. That's why you need to understand that panic is a stronger emotion than confidence. It's very important to understand this because based on this, we will have our strategies surrounding what actually moves the market, the buyers and sellers, and how to create a strategy surrounding that. So as I explained, in 2020, I started focusing on the market fundamentals, the buyers and sellers. Buyers want the price to push towards the upside. The sellers want the price towards the downside. Now we need to understand the fundamental of the market again. What is volume? That is, volume is still going to be in the part 1 of the section of this masterclass. What is volume? So volume is basically one transaction. There's a buyer right here and there's a seller right here. There's a seller right here. So if they are buying, a buyer is like, I want to buy one share from seller. This is the buyer, this is the seller. That corresponds to one volume, not two. This is a common misconception. Again, it's very simple to understand, but it's just good to know. And you should know that one share buy and sell is not like two. The volume is going to correspond to one, because volume is a transaction going on in the stock market. A lot of order flow traders, I look at order flow, I call myself an order flow trader. They will be like, if the buyers are strong, then it's like there are more buyers buy, there are more sellers sell. But have you asked the question why again? For a buyer, the buyer can't buy the share without any seller. So more buyers doesn't make sense if there are more sellers as well. Like for the more buyers to get filled, they will need more sellers. If this buyer wants to buy two shares and if there are no sellers, what's the point? So eventually each buyer has a seller has a buyer. And that is why the volume is there. One buy and sell transaction is volume. So every buyer needs to have a seller. Every seller has a buyer to correspond to one volume in the stock market. So having more buyers or more sellers, yes, I understand where the traders are coming from, where I come from, but understanding the answer why is very important. When people say more buyers, they don't mean more buyers per se, but it's more about the buyers are aggressive. The buyers want it now. Instead of thinking about there are more buyers. Yes, there might be more buyers, but they want to buy that stock in the next 6 months. It's not like the stock has to go towards the upside. Same thing as seller. When you're looking at the seller and they want to sell a position, if they have 6 months to sell that position, doesn't make sense. If the seller wants to sell the position now, how aggressive the buyers or sellers are, that's what moves the market. That's what you need to understand. How aggressive the buyers and sellers are, that's what moves the market. If the buyers are more aggressive than the sellers, the stock is going to go towards the upside. If the sellers are more aggressive than the buyers, the stock is going to go towards the downside. So that is also another very important fact to understand, that more buyers or more sellers doesn't mean anything. How aggressive the buyers are, how aggressive the sellers are, what is happening between the buyers and seller, why the transaction is actually happening, where the transaction is actually happening. That is more important to understand when you look at the order flow. Now let's try to understand two types of volume. That's what people look at as well. Volume by time and volume by price. So the most common thing about volume is that people look at volume by time. So that means you're looking at a candlestick chart. We're going to talk about the candlestick as well. I don't know, but I'm going to speak to a complete beginner now. So when you're looking at a candlestick, which is like just the most common type of charts people look at. Let's take an example of a green candlestick. This is just another basic class, but I am just talking to a lot of beginner trader as well, because this is a master class. I want to cover what a candlestick is, but if you have been trading for a while, you can skip this section. A candlestick will give you 4 things, and that's why it's important to focus on the volume as well. Then it's going to give you the high, open, low, and close. So in both the candlesticks, both the examples, the high and low is going to be the same. The high of the candlestick is going to be the high of the wick. Low of the candlestick is going to be the low of the wick. High of the candlestick right here is going to be the high of the wick, and the low will be the high of the low of the wick, the low of that candle, whatever time frame you're looking at. This might be a 1 minute candle, it might be a 5 minutes candle, it might be a 15 minutes candle, whatever time frame, the basic fundamental thing is the same. Now, if it's a green candle, because if it's a green candle, that means the stock closed near the high. That means the stock closed above the opening price for that candle. This is the close, this is the open. Now, if it's a red candle, again, very basic class, not basic class, but basic section of this class. The close is going to be under the open because it's a red candle. That means the close is actually under the open. That's why it's a red candle, because the price moved towards the downside. It closed towards the downside during that duration of that candle. It might actually be a 1 minute candle, 5 minutes candle, 15 minutes candle, 1 hour candle, 1 day candle, whatever. It's the same example. So these are the candlestick. But they don't tell you the candlesticks. Yes, it's very important. We are going to look at the technical analysis and everything. Candlesticks are very important. These candlesticks are very, very important. But these candlesticks, along with volume, is checkmate for the market. This is like you are playing chess with the market by just looking at the candlestick patterns, the candlestick chart. But if you actually include volume with the candlestick, you can checkmate the market. But now, I mentioned that there are 2 types of volume. So 2 types of volume. One is going to be volume by time, VBT, volume by time, and other will be volume by price, VBP. Let's talk about these, right? So volume by time just means that during this candlestick, one candlestick of the 1 and the 5 or the 15 or the 1 hour or the 1 day chart, how much volume did the stock do? So that might be, and that is the volume that you see at the bottom of your normal chart. If you open any trading charting platform like TradingView, that is what you're going to see. You will see like a volume bar right here, and that volume might be like 500 shares, 1 million. Let's take an example like 1 million shares within 1 hour. one day is going to be more than 1 million if you focus on the big name. But let's say for the sake of an example, 1 hour bar had 1 million shares. That is volume by time. Within that 1 hour duration, the stock or the asset class, whatever you are trading, did 1 million shares. That is volume by time. Same thing can happen towards a green side as well. Doesn't matter. The color doesn't matter. At the end of the day, the volume can be 1 million this side as well. So that means you're looking at that one candle. That can be a 1 minute candle, 5 minutes candle, 15 minutes candle, 1 day candle, 1 hour chart candle. Within that duration, 1 day, 1 hour, 5 minutes, whatever, the candle, that stock, that asset class did 1 million shares. That is volume by time. That means you're focusing on within that time duration, that asset class did that much volume. What is volume by price? That is another important thing to understand. Volume by price means that if the stock, in this example, let's take the green example because everyone likes green, and the stock moves from say 0 to the open was 5, the close was say 10, and the high was say 15. For the sake of example, 0, 5, 10, 15. How much did the stock, that asset class, did volume, approximately volume by price, at 5, at 7, at 10, at 11, at 12, at 15. So it gives you the volume by price. So for example, I'm going to draw this candle again, the same candle again. This is the volume by price. So whenever you look at a chart, like on TradingView, whichever platform you use, you see the price on the y-axis. This is called the y-axis, right? Yeah, y-axis and x-axis. This is the time and this is the price. So first we focus on volume by time. That is what you see on the candlestick chart. Like this is volume by time right here. Now volume by price is going to be how much that within that one candle, that price action, for example, this is again 0, 5, 10, 15. How much volume did stock do at say $9 level? You can't tell that with the help of volume by time. That volume by time is only giving you volume for that one candlestick. That might again be 1, 5, 15, 1 hour, 1 day chart. But if I ask you the question, why, how much the stock did volume at $9? How much volume did the stock do around $9 or at $8, at $8.5, at $7? That is what you can see from volume by price. That is also very important to understand. Volume by time is easier. That is going to be the level 1 of our understanding. Volume by price is going to be the level 2 of our understanding. Level 1 is going to be easier. Volume by time, you can look at this and look for good entries and good exits. And volume by price is the next level, which is the order flow. When you read the order flow, because the orders are based on the price, right? Want to buy 7,000 shares at $7. That is volume by price. That's why volume by price is a level 2. It's a bit more advanced thing that you need to understand. Level 1, volume by time, it's a bit more easier to understand. So now let's talk about the level 1. Now, volume by time is very simple to understand. We need to focus on anomalies and the normal price action. In normal price action, normal trending price action, there should be high volume on trend and low volume on consolidation. So the market moves in cycles of expansion and compression. So that is very important to understand. When we expand, that means the market is going towards the upside or downside. The volume should be high. Ideally, normally the volume should be high. On consolidation, the market is now consolidating after a big expansion towards the upside. This is the compression phase. Ideally, the volume should be low. Volume by time, because we are looking at time. We had this good push towards the upside. That means on your chart, TradingView, whatever platform you use, you should see ideally high volume on this expansion move and low volume on this compression move. So ideally, this is the best case scenario, that on the expansion, you see high volume, on the compression, consolidation, you see low volume. Same thing towards the downside. We push towards the downside and then we consolidate. Expansion, compression again. So this is compression. On the expansion, ideally, you want to see high volume, volume by time again. And on the compression, you want to see low volume. That is the normal price action that you should see. Now, if something is happening out of the ordinary, that is what we need to focus on, and that is what I call anomaly. So this is the normal price action. So now we have to talk about the anomaly. What happens? Like, anomalies are something that you don't expect to happen is happening in the market. This consolidation is say on high volume, or maybe it breaks out towards the upside on high volume. This is something you need to focus on. Anything that is low volume on the trending days, you need to focus on that, because on trending expansion days, the volume needs to be high. So now I'm going to give you guys two examples and try to understand this and how you can avoid fake outs, and then we can jump onto the risk management and then the technical section of this masterclass. How can you use volume by time to your advantage? We are pushing towards the upside. Then finally, we are maybe say volume is high volume, and then eventually as the market expand, the volume should slightly go down, because yes, the buyers are buying. The first move usually is on very high volume, the next move can be on even higher volume, but eventually when the market starts to die down or gives you signs of exhaustion, the volume should start to slow down. That is a normal price action, but this is the normal price action. What is the anomaly? When you focus on the anomaly, the market is going towards the upside, and then you see a doji right here. Doji is a sign, is a type of candlestick. So we explained the bearish candle and the bullish candle, the green and the red candle. Doji is something, it's simple to understand that during that body, I explained the example of this candle. This is, again, if it's a green candle, the close is going to be above the open, and this is going to be the low, this is going to be the high. But this is called the body, these are the wicks. Simple to understand, right? But if the candle is like a doji, that means if it's a red doji or green doji, honestly, if it's like a proper doji, the color of the doji, that doesn't make sense, because the close and the open are very close to each other, and this is the high and this is the low. That means the body is really small. This is indecisiveness. The buyers did not win, the sellers did not win either. Now there can be different sorts of dojis. For example, huge wick and kind of relative body is also bigger than this one. In this, yes, the color actually makes sense. In this case, when the body is really small, it doesn't matter if it's green or red, because the close and open are very close to each other. In this, yes, it's going to matter if the close is under the open, and this is the high, this is the low. Then if it's a red, then we can say that it's a bearish doji. But at the end of the day, there are many different types of dojis, like dragonfly doji. That's my favorite name. Again, as I mentioned, we don't care about the names of the dojis. We care about why the doji actually forms. This is the anomaly right here. We are pushing towards the upside. We are making a doji. So what happened inside that doji? Why did this doji happen? If this doji is on just like low volume, doesn't mean anything. That's why people say that just trade the candlestick chart pattern. A doji by itself on low volume doesn't mean anything. Because if you look at a doji just by itself, like a small doji, maybe like this doji, very small doji with low volume, it doesn't mean anything. And it's like, okay, there was indecisive consolidation for one day, no one won, it's completely okay. If you see a doji on high volume, that is what I call exhaustion volume, right? This is the strategy, market DNA. If you use volume analysis, the level 1 and the level 2 of volume analysis, along with the technical, along with the order flow, it's gonna checkmate the market. You will be able to checkmate the market and make money from the market. Exhaustion, what is exhaustion? This on high volume, that means it's a sign of reversal. So just pure candlestick traders, they won't even focus on that. They will be like, okay, a doji on high volume, or not volume, a doji, sign of reversal. This doji might be on low volume, it might continue the trend towards the upside, you get stopped out. And that is where 50% of the times it actually works out, 50% of the times it won't work out. But when you look at the dead chart, you will focus on the 50% of the times it actually worked out, and you will develop a strategy surrounding that. And when you're actually trading, you're like, this was a doji, I should have made money, I lost money. And that's what happens. That's what happens with me. That's what happened with me as well. So a doji on high volume is a sign of reversal, is ideally a sign of reversal, normal price action. But anomaly is that we saw a doji on high volume. Okay, I need to focus on that. Why did this form on high volume? Why? Answering the question to why again. So what happened inside this doji on high volume? Important to understand. Buyers pushing towards the upside, Eventually buyers are winning. First sign of seller. Sellers came into the picture with high volume. Volume is the fight between buyers and sellers. That's what I mentioned. That's why we started with what is volume, one transaction between a buyer and a seller. High volume means there was huge fight between buyers and sellers. So you need to understand that. Low volume means the fight between buyers and sellers is not that much. The buyers and sellers are fighting, they fight all the time, but the fight is not really huge. Like, it's not a huge fight, just a normal fight. But if the volume is high, that means the fight was insane, and eventually one side or the other side won. Base depends on how the candlestick actually closed like. But if you see a doji on high volume, that means the buyers tried to push the stock towards the upside. Eventually the sellers showed up, they were able to close the price towards the downside, and it closed like a doji. First sort of indecisiveness during this uptrend on high volume. High volume means the sellers showed up with strength. Insane fight between the buyers and sellers, that can be a sign of reversal. Again, I'm not saying it will be a sign of reversal. It might not be a sign of reversal. It can be a sign of reversal. But you focusing on just candlestick without volume, I would give you like a 50% chance of you making it and that trade working out, or maybe even 40-60% chance. But you focusing on volume gives you, say, 75% 25% chance. That means 75% of the times this trade might actually work out. That is your job as a trader. 80% of the time this trade might actually work out, and 20% it's going to fail. So that is the difference between trading and gambling. This is gambling. Because when you gamble, when you go to a casino, the stacks are always against you, right? It's gambling. Like, you are trading, placing a trade to make money. That is pretty much gambling. The trade might work out, it might not work out. So you don't know for certain that it's going to work out. Your job as a trader, instead of a gambler, is to stack up the odds in your favor. So if you're not focusing on volume, your odds are worse than gambling. In gambling, if you're playing like blackjack, you might have 51% chance of losing and say 49% chance of winning, because at the end of the day, the casino always wins. And that's why they have huge hotels. Like, the buildings they have, it's coming from your money, the money you lose. At the end of the day, in the bigger picture, in the long run, the odds are always stacked against you when you gamble. In trading, the only advantage there is in trading is that you can stack up the odds in your favor by looking for high probability trade setups, A+ setups, playbook setups with the help of risk management, which is going to be the next section. We are coming to that next section. And you can stack up the odds and increase the odds from losing odds to winning odds. At the end of the day, if you focus on volume, if you focus on order flow, you can increase the odds of any sort of chart pattern, working out from 50% to say 70-30%, to say 80-20%. That is your job as a trader, that you can stack up the odds in your favor with the help of taking good strategies, using good strategies, having good playbook setups, taking good playbook setups, and then focusing on volume by time and volume by price as well. So this was the level 1. This can avoid you a lot of fakeouts. Level 1, which was volume by time, it can actually increase your odds from say 50 to 70% to 75%. If you want to increase your odds to 85-90%, that is a level 2 of volume. Again, your win rate won't be 90%, but on the really good setups, when you focus on level 1, including level 2 as well, both these level 1 and level 2, you can stack up the odds in your favor of that trade to be a nice winning trade with very high risk to reward. Talking about risk to reward, that's a nice way to end this fundamental section of the market. In this section, we discussed what moves the market, what is a candlestick, and volume by time. We discussed the basics of volume, because the buyers and sellers are what moves the market. And when the market moves, that means the buyers and sellers are transacting, and one transaction is one volume. Now comes the class of risk. This is the chapter 2 of the masterclass. Why chapter 2? And we are talking about risk even before the setups and strategies, because you can have the best setup in the world. Without risk management, you will lose money. And that is why I like this section to be the first kind of section, introduction, because the first section of the masterclass, the first chapter, was actually talking about the market fundamentals. So now we're going to dive into the strategies, what actually the levels of significance, the technicals, and the order flow in the next few sections. But why are we starting with risk section? Because if you don't focus on this, all the other sections I talk about later are like waste. You will lose money at the end of it. There's no point, because if you're not focusing on risk and risk management and how, because at the end of the day, you can have a 80-20% win rate, you can still lose money, because on those 20% of the trades, if you're losing more than you are making on 80% of the trades, it's a bad strategy. On the other hand, even if your win rate at the end of the year is say 40 or 60%, but with proper risk management, you can still be profitable if you're making more money on those 60% of the, if you're losing less money on those 60% of the trades and making more money on the other green 40% of the trades. So it's all about risk management. That's why if you don't talk about risk, the next few sections are going to be useless, and it won't be any importance for you guys if you focus on the next strategy section without understanding the risk. So now, risk is very simple to understand if you just take these two things. First thing and the second thing. So it's not like the first concept and the second concept. The first is going to be for a beginner trader. This is, I would say, anywhere between 0 to 12 months. That is the beginning stage of your trading journey. This is going to be if you're consistently trading. Again, I don't like to give a time frame for consistency, because it might take you 6 months, it might take you 12 months, it might take you 18 months, it might take you 36 months. Depends on how much time you put in and whether you have that sense of urgency or not. Because if you keep repeating the mistakes that I was making within the first 11 months for the next 11 months, you won't make money for 22 months. Simple mathematics. So you need to have that sense of urgency that there's something wrong about my trading and I want to work towards it. I want to fix it. And if you have that sense of urgency, you can make it as a trader within like 6-7 months. But talking about risk, your risk will still be different as a beginner compared to an intermediate or advanced trader. As a beginner trader, your risk needs to be constant. So that means you're risking X amount of money every trade, and if it's a green trade you make X, and if it's a red trade you lose X. Your risk is constant. That means on a green trade, for example, your goal should be that your risk to reward is ideally more than 2 to 1, but personally I look for like 4 to 1, 5 to 1, 6 to 1 risk to reward ratio. That means you're risking $10 to make $50. You're risking that is a 5-hour trade. That means your risk was $10 and your reward was $50. Your risk was say $5, your reward was like $50. That is a 10-hour risk reward. This is a 5-hour reward. But as a beginner trader, your risk, this risk factor, $10, I'm willing to risk $10 or $5 on that trade, needs to be constant. And the answer is, because a lot of people talk about dynamic risk, which is the second step, but the first step is constant risk. Because if you risk more money as a trader, because as a beginner trader you don't have a playbook, so how would you know which setup you need to increase your size on? Important to understand, because if you don't have a playbook, if you don't know which setup I want to increase my size on, which setup I want to decrease my size on, it needs to be constant. This is one variable that you can control as a beginner trader, because as a beginner trader you don't have the variables of like this is an A plus setup, this is an A setup, this is a B plus setup. You don't have that because you haven't been trading for a long time, to be honest. Like as a beginner trader, within the first few months, even if you make money, unfortunately you don't have the experience. A doctor who has done a few good surgeries within the first few months isn't as good of a doctor as a doctor who has been doing surgeries for 6 years or 10 years or 20 years. That's a simple fact. So it doesn't matter if you're making or losing money. Your risk needs to be constant as a beginner trader because you don't have a playbook. This is the only variable you can control as a beginner trader. So me, as a beginner trader, I started with trading shares, not options. With options, it comes the dynamic risk part. But with shares, you can risk like $5 on a trade. You can risk like $10 on a trade. You can risk like $15 on a trade. With shares, it's possible. You might lose like 5.5, but rough ballpark, right? Spreads and everything, they can also contribute. But you can lose $5, $10, $15, but that needs to be consistent. Like, okay, for the next 4 or 6 weeks, I'm going to risk $5 every trade. For the next 6 weeks, I'm going to risk $10 for every trade. For the next 6 weeks, I'm going to risk $15 for every trade. Why? Because your risk is constant. Then you can look for high risk to reward trades. Like, okay, on this $5, the first trade I took, risking $5, I made like $20. That is a 4-hour trade. Was it a good trade? Was it like a clear strategy based on the technicals and the order flow, which we're going to talk about later? Is that a good strategy based on that? If the answer is yes, then you playbook that trade. That is an A plus setup, and that will help you with the level 2 right here. But as a level 1 beginner trader, your risk needs to be consistent and constant. Your risk is that I'm risking $10 every trade, I'm risking $20 every trade, and your risk remain constant and consistent. I'm going to risk the same amount of money every trade. Then once you get enough experience, once you have been trading for a while, once you have been trading for say 6 months, 8 months, you constantly work on developing a playbook with the help of your journal. So I should have talked about journal as well in level 1, but level 1, that is a chapter 1 of this masterclass, you should focus on maintaining a journal. That includes your emotional journal, your technical journal. Emotional journal, like, was I thinking about taking my profits early, or why did I hold on to my loser, or any emotional thing that I want to pay my rent or whatever, like, so that comes into the emotional part. But you need to maintain a journal since day 1, because if you don't maintain a journal, these 2 points are useless. Then you need to maintain a journal, and once you have the journal, in that journal you also mark all your entries and exits of the trades. You mark your playbook setups. You mark like, okay, this was a 4-hour trade, this was a 5-hour trade, and you can actually get a template of my journal. That is a Notion journal. You can follow my channel, and any video, there will be a link in the description box below, like playbook template journal. You can download it for free, and it's like risk to reward. You risk like $5 to make $20. That journal is going to tell you, okay, this was a 4-hour trade automatically. That is the step 1. That is the step 1 of risk. As a beginner trader, your risk needs to be constant. It needs to be consistent. Now, as an advanced trader, intermediate trader, when you transition from being from a beginner to intermediate to advanced trader, that's when you have a well-defined playbook. So now there's another variable. As a beginner trader, you don't have a playbook. It's like, okay, every trade you take in your head is going to work out. So you don't have a playbook as a beginner trader. So the only thing you can control, the only variable you can control is like risk. That's why that variable needs to be constant. That risk needs to be constant. But as an intermediate and advanced trader, there's another thing you can control, that is position sizing. And that is what you can control with the help of your playbook setups. So as an intermediate and advanced trader, once you start working on your playbook, that journal needs to turn into a playbook. I'm going to talk about journal and playbook in the next after this section. It's going to be, once you have a playbook defined, that means you know it's an A++ setup, this is an A- setup, this is a B++ setup, this is a B- setup. Now you have these criterias as an intermediate trader, because you have the backlog, you have the journal, like these are my setups. My brain works nicely on this setup because all the brains are different. I can tell you that be a swing trader. Swing trader is good, is better than day trading. Day trading is better than scalping. I'm going to give you all this, but it won't work out. And that's why when people say that you should move from day trading to swing trading, I'm like, okay, do you like Italian? I like Italian. You might hate Italian. So that there's no point. Like that argument of being a day trader versus a swing trader is pure BS. All the brains are wired differently. Some people are slow, some people are fast. Nothing wrong, nothing against them. Some people can run 100 meters within a few seconds. Some people can run 100 meters not even in 1 minute. Brains are wired differently, the body is wired differently, and your brain is also, a physiology of your brain is different. So your physiology of the brain is different than mine. So I can give you my playbook on a silver platter. Follow this playbook. I have been making money for the past 5 years using this playbook. You won't still be able to execute because your brain is wired differently. That's why you need to have your own journal, your own playbook. Your beginning stages are going to be important for your own trading journey, because then you are like, okay, my brain actually works nice like during momentum. When the momentum is nice, the market actually, some people are a bit more risk averse, nothing wrong with that. They can turn into like, okay, wider stop loss, wider profit target. Swing trading is good. For some people, the brains are wired differently. They think very quick. They are like enter exit, enter exit, enter exit. So it's going to be day trading or momentum trading or scalping. So no two brains are different. If anyone is telling you that move to swing trading from day trading, move to day trading from swing trading, they are just like, don't listen to them, block them, don't listen to them. They are just like, they think that all the humans on this planet are similar. Because I tried swing trading and I'm purely a day trader, but for swing trading, it just requires a different mindset. So you can either work towards your mindset, or you can try your best to be the best trader out there, best day trader out there. So it's not about being the best for someone else. It's about being the best version of yourself. So if you focus on your one thing and you are like, okay, this is my brain and my brain works nicely with momentum trading, master that, because you can be either master of one or mediocre at everything. That is very important to understand. Master of one or mediocre at everything. So that means you have a journal, your own journal. You are taking notes of your own mindset, your own journaling, your own psychology, your own trading style. And you are like, okay, this was a 4-hour trade, this was a 5-hour trade, this was an 8-hour trade, this was a 10-hour trade. I should focus on these trades more. That's when you start developing your playbook. It's very important. This is the most important book you can have as a trader. And once you start working on your playbook, you mark your setups as A++, A-, B++, B-. Now, it's going to be stupid of you to risk the same amount of money on a B- setup and A++ setup. Simple, like, because now this is the variable that you can control. You can take an A++ setup, increase your size on it. You can take a B++ setup, decrease your size on it. You can take a B- setup, decrease your size on it. You can take a C- setup, but don't even trade a C- setup, because if it's C- and you know it's a C- setup, don't even take it. So now you can control the position sizing. That is another variable you can control. So at first, you need to manage your risk as a constant risk. My risk is going to be constant, $5, $10, $15, $20, whatever that is for you. I'm going to leave it to you. But as an intermediate and experienced trader, you start working on your playbook. And once you have a well-defined playbook suited to your trading style, your brain, as I mentioned, no two brains are the same. Once you have a trading style that fits your personality, your brain, your thinking style, your speed of thinking, your emotions, your lifestyle. Lifestyle is also important. Some people have a 9 to 5. They can't day trade, so they can do swing trading. Some people are like, I can't swing trade because I want to be a day trader. I want to take vacations. Like, I can't hold a position and take a vacation. My brain is like, I'm constantly thinking about the trade. So all no two brains are the same. So that's why all the types of trading work if you know what you're doing and you are just being true to who you are. If you know who you are, which you're gonna get from journaling, once you journal, you will start knowing who you are, the setups you make most money on, and the setups you make most money on, that those trades are gonna turn into your playbook. Once you have a well-defined playbook, then you start focusing on dynamic risk. So what is dynamic risk? As an intermediate and experienced trader, your risk turns into dynamic risk. That means you don't risk the same amount of money on any two setups. If it's an A++ setup, you go all in. And if it's a B- setup, you risk less. Not like all in, don't blow up your account, because that A++ setup, I'm going to give you probability of that trade working out, say 90% or 80%. But still, there's a chance that you might lose money on that trade, 90-10%. So don't just blow up your account. I'm going to put all my money on this A++ setup. That's not how it works. That's not good for longevity. Now, the answer, why does this actually work out? Dynamic risk. Why? To keep your risk dynamic. And we started this masterclass answering the question why you should watch this. Now I mentioned that we are going to keep answering the question why during this whole masterclass. The simple answer is 80-20 rule. It's called the Pareto principle. I don't know how to pronounce it, but it's going to be Pareto. So it's a fact for me and a fact of most of the consistent traders that 80% of your profits of the year will come from 20% of the trades. So now that means that automatically defies the laws of the constant risk. That means consistent risk, because you need to risk more on those 20% of the trades to make 80% of the profits. I'm going to give you an example of my own trading. The money I make on trades vary wide, it's like this year, example of this year, I don't know when you guys will be watching this masterclass, but this year, I won't name the year, but I made my biggest trade was 93K, and usually my average is around, say, 15-20K, like 10-15K, whatever, right? So this varies a lot, and this varies a lot for all the experienced traders that I know of. Not like all, but people I know of, people who I look up to. They are not showing up every day. They are showing up, say for example, there are like 215 trading days in a year, 250 trading days, like Monday to Friday, excluding the public holidays. And based on your stats, that is a very important statistic that you can see from your trading journal, whatever trading journal you are using. Open that journal and see how many trading days you have traded. If you have traded like 240 trading days or 250 trading days, which was me 2 years ago, these days is going down. This is bad, because you don't see a playbook setup every day. Because once you have a well-defined playbook, you will be like, okay, these playbook setups show 5 times in a month maximum. On a good month, maybe 10 times in a month. On a bad month, not even like one playbook setup. Usually it's like 2 or 3 playbook setup. On an average, you will see 5 to 6 playbook setups in a month. And if we think about this, there are 250 divided by 12. It's going to be approximately, say, 20 trading days in a month, average approximately 20 trading days. That means out of those 20 days, on an average a month, you are seeing 5 or 6 playbook setups. That means, say, 6 trading days out of 20 trading days are actually good. That means in theory, you should only be trading approximately maximum 100 trading days in a year. Maximum, right? Ideally, it should be more like 60 to 70 trading days in a year. That is going to come with this won't come during the intermediate stage. So we talked about the beginner, intermediate, and advanced. Intermediate is going to be you trade every day, almost every day, and then you see the results, and the result of trading every day, that you lose a lot of money. Then you are like, okay, I can't trade every day because my playbook setups only show up 5 times in a month or 6 times in a month. So I'm going to focus on my playbook setups and trade less and make more. And that's where the 80-20 rule comes in. You trade those 20% of the trades to the best of your ability, increasing your position sizing, increasing your risk on those setups, and make 80% of the profits. So now, just to recap the risk section, we talked about 2 steps. The first step is going to be the beginner trader. The first concept, you keep your risk constant. And the second step, the second concept of the risk was, once you are intermediate and advanced trader, you focus on the 80-20 rule. 20% of the trades will give you 80% of the profits. So if you don't size up on those 20% of the trades, and if you don't trade them efficiently, that means you're not making the most of your profit for the year. And then comes the advanced version inside that second concept. Intermediate, this is the intermediate stage. And then advanced stage, you will be like, okay, my playbook setups only show up 5 or 6 times in a month. So if I don't risk more on these 5 or 6 times in a month setups, then what's the point of even trading? So that is very important to understand. Eventually, you will get to a stage. It won't happen within the first 1 year, but the more you trade, the more you will realize that as a beginner and intermediate trader, you need to spend a lot more time trading to gain the knowledge. But once you have the knowledge, once you exchange your time for money, you start exchanging your money for time. So that means I'm only going to show up a few times in a month with nice capital, and these are the trades I'm going to make the most money on, because at first you're exchanging your time for experience, not money. You're changing your time for experience. As a beginner trader, you exchange your time for experience. I'm just going to mark it as experience. So now, once you are exchanging your time, you're showing up every day, you are journaling, you are playbooking. Once you have your playbook, you slowly start transitioning into you exchange your experience for money. You are exchanging your time for experience. Once you have the experience, you are you're exchanging your money for your experience for money. That means you have the experience. That means you have the playbook set up. You have worked on your issues of not holding on to your winners and cutting your losers short. You have worked on all these issues. You have the experience. You have your playbook. You know when to size up, when to size down. Then you exchange your experience for money. During this stage, you don't exchange your time for money. So that means you are not required to give a lot of time to trading. You show up like every day, but you trade a few times in a month, because now you're exchanging your experience for money. You'll be like, this setup is B plus setup. Let's preserve my capital. This setup is B minus setup. Let's preserve my capital. This is an A setup. Okay. This is an A minus setup. I'm going to risk, say, $5,000 on that setup. This is an A plus plus setup. I'm going to risk $10,000 on that setup. And this is like A plus plus plus. Like, this is a setup that shows up once in a few years, once in a year. You will get that sense. You will get that feeling that intuition is going to work in your favor. You will develop that intuition with experience. And that's why experience comes intuition. People are like, a lot of traders are like, I got that gut feeling. I knew that the stock is going to go towards the upside. I knew that the stock is going to go towards the downside. That comes with experience. You can't have that as a beginner trader. You can't have that. But as an experienced trader, then you are like, okay, this is an A plus plus setup. Like, it's going to show up once in a year. I'm going to risk 20,000 on that setup. So this is the dynamic risk, and this is how you exchange your time for experience. At first, you're showing up every day, journaling every day, playbooking every day, and then your experience, then you convert, you exchange your experience for money as an intermediate, and especially as an advanced trader. So that was